Official gold sales. This is the only method I make mention of that has the potential to suppress the price of gold that is not being done surreptitiously. Let me first point out that it is essential to realize that central banks are not governmental institutions like the parliament or the government's administration. Although it is true that most central banks have certain governmental privileges and features, they are in essence private banking organizations. Central banks do not have the legal authority to sell the gold of the nation it is residing in. The selling of the nation's gold has to be mandated by the proper governmental institutions. In the US, for example, the President and Treasury Secretary can dispose of the US gold reserves. Yes, that might be quite shocking to hear. It is true that they do not need congressional approval in order to sell the nation's gold. In some other countries, like the one I live in, there luckily for me is more democratic oversight to the sales. These official gold sales supply the market with extra gold, so in order to balance supply and demand, the spot rate of gold will drop when the gold hits the market. But as we will see in the infamous Brown's bottom case that occurred in the late 90s and first part of the new millennium, the price of gold is destined to fall once the official gold sales are announced. You see, because of the expectation of gold flooding the market, people will sell their gold, locking in their profits, and in anticipation of a price drop, investors move their long to short positions in the futures market. So even when no physical gold hits the market, just an announcement of a large gold sale by a central bank or a supranational organization like the IMF can trigger a drop in the price of gold. This Pavlov reaction of the gold market can be used to suppress the price of gold even when there is no real intention of flooding the market with actual physical gold. Keeping this in mind, you might like having a closer look at the history of proposed gold sales by the IMF over the last couple of years. The IMF announcements of large gold sales scare investors and prices drop once the announcements are made. Most of the time though, the large gold supplies the IMF said to dump on the market never really hit the market, and in hindsight there should have never been a reason to fear a drop in the price of gold. One last thing to mention about these official gold sales is that the major central banks of the world are limited to a coordinated sale of gold reserves to a maximum of 500 tons a year. This they agreed upon in the Washington Agreement of 1999, which has been renewed in 2004 and 2009. And as you can see on this sheet, the demand for gold for a decade now exceeds mining production over 1,000 tons a year. Since 1999, central banks have officially sold 3,687 tons of their gold, and despite these massive sales, the price of gold has tripled during this time frame. Now let's have a look where all this central bank gold came from. So, looking at this index, since 1980, the official gold reserves of the Western nations decreased dramatically. That is, with the exception of the United States of America. According to the official IMF record, their gold reserves dropped only 1% the last 30 years. Even though the US national debt surged from 712 billion in 1980 to 12.3 trillion nowadays, the US gold reserves only diminished 1% during this period. Well, it's a good thing for the American citizens to know that they can still rely on the world's largest concentrated amount of gold bullion in their nation's vault in the face of this serious economic downturn. But then again, the US gold reserves have not been independently audited for the last 50 years. So to accept that the 1% drop of gold reserves over the last 30 years is for real, you have to accept that the government and or Federal Reserve are telling the truth about these reserves, that nobody else but them even has a remote chance of verifying. And considering the appetite for gold by the marketplace in yearly excess of over 1,000 tons, the mining production, and watching non-Western central banks like India or China hoarding the cheap gold hoarding all the cheap gold they can get hands on, it might just be that gold sales to the amount of 500 tons a year are not sufficient to prevent the price of gold from exploding and maintain a strong dollar policy. So, if the US didn't sell vast amounts of its gold, could it be it just lent the gold to the market? In the next video we'll have a closer look at that possibility.